let me move forward and introduce Adam, also known as in the real estate community as Triple A, has educated thousands of investors through real estate conferences, radio, and podcast interviews, his coaching program, and his thriving Meetup group. Adam hosts the Creative Real Estate Podcast, a podcast which is listened to around the world with hundreds of thousands of downloads. His efforts to educate and inspire other investors have earned him the prestigious title Master Investor by Think Realty magazine. He has also a 3-time Hall of Fame winner of our real estate mentor for his successes in multifamily syndication. Meetup.com recognized him as one of the top 6 Meetup organizers in the world in 2018. That is pretty phenomenal. He is also the founder of growyourshow.com, and this is focused on how to develop and launch your own podcast and to be wildly successful. And so now, and I also want to ask, I believe the last time I heard you speak, Adam, you were about to launch a podcast on podcasting. Did you do that?
Yeah.
Nice.
It's all launched. Pop, yeah. We call it.
Cool. Awesome. That's great. So, let me, I want to get into that, but let me just ask a few questions before you get into your presentation. So folks kind of get to know you a little bit better. How did you get started in real estate to start? Let me just start there. How did you get in real estate, and kind of just tell us that story?
Yeah. My stepdad is the reason that I got into real estate. And growing up, he was really like wanting to pour into his stepkids, and just such a remarkable guy. He always told me to save 10%, invest 10%. And he bought the game Rich Dad, Poor Dad. The month that it got out, we had it at our house. Like this is like in 1997 or something like that. And he wanted to play it all the time. I never wanted to because he told me it was an educational game. So I was like, okay, then obviously I don't want to play that one. But later on, he gifted me a piece of property. So that was 2005. I was in college, and that's the way that I got in. He knew that I probably wouldn't ever be a real estate investor without him purchasing something for me. So he did it. Random fact though, I ended up having to pay for the property later because his accountant said that he couldn't just give it to me. But at any rate, that's how I got started. And I was bartending, putting myself through college, and I was doing okay bartending. I thought I was doing well, $100, $200 a day. And then when I sold this piece of land in 2007, I made more money in that year from selling this property than I made that year in bartending. So I thought to myself, I'm not going to become a music teacher. By the way, I'm a musician. And I'm not going to finish my degree. I'm not going to do this and make less than I could if I did real estate. So that was my turning point, 2007. And my next step was managing apartment communities. And my third step was owning apartment communities. So I bought my first apartment in 2008. I was managing properties for about a year before that, though.
Okay. And did you do any single family homes other than that one that was gifted to you, or you just went straight into multifamily?
Not until 2015 is my first single family. Yeah.
Okay. So then
10 years later.
And did you, well, maybe because of the game that you played, did you understand the power of apartments at that time?
I'm a very curious person, and I do things that not everyone does. So I studied Robert Kiyosaki's life after reading that book. I started trying to figure out what he did and how he did it. And that was when I learned in 2007 that he never invested in single family. Most people have no idea, but I learned that, about 14 years ago. And I decided I've got to focus on what he focused on, which was syndication. He would make as much money as he could in his business, and he would put all the money that he could into apartment syndication, mostly as a passive investor, and mostly with that guy named Ken McElroy, and stuff like that. But I decided that's what I got to do. But if I want to own multifamily, I've got to figure out like how it all works. And so like, that's why I decided to start managing property. And it was funny because I never really thought, oh, I want to live in an apartment. Like I had never thought that before until 2007. And I started calling apartment communities like between 4 and maybe 25 units if they had a for rent sign. And my pitch was to every single person, I want to live for free and be your property manager. Terrible pitch, but eventually it worked. And this guy named Reed Quinn ended up letting me manage his 18 unit. And I did so well that he wanted me to manage his 4-plex and a condo as well. So I was doing all 23 of his units in southern, like central Utah by Provo. And one quick fact that is super interesting and I'm proud of, the 18 unit that he bought the year that I started helping him in 2006 or 7, he sold in 2008 for $1 million profit. So wow. I learned firsthand by doing without all the risk of owning, and he just poured into me. You need to raise the rents. These are the types of materials you should be using. And this is how you hire people. And so I learned a ton from Reed. And once he sold that piece of property, I was like, I'm ready. Like can I swear? I'm the best. I'm the best. And so I went ahead and started investing.
That's great. And then in that first investment, were there bumps along the way? You're like, what were the things that you were like, oh man, these are some like heavy lessons I learned. And maybe you can give us a couple of those nuggets and say, yeah, don't do this, try this instead. This thing, maybe you did right. And, that would be a good one to kind of describe too.
Absolutely. I overimproved it. So I wasted money. It was like my pride and joy. I wanted it to be perfect. And so like, instead of just painting the cabinets, I went and bought new cabinets. And instead of picking like ceramic tile or linoleum or some other type of flooring, I went and got like travertine, which back then was more popular than it is now. And I poured into it. I was like, it needs to have 3-tone paint, which costs a lot more than 2-tone paint or even just one color. And then this one wall, there was a fireplace and it was taking up almost the entire wall, like all bricks. And I thought to myself, bricks are ugly, they're outdated. And so I learned how to do this weird type of painting. I'm having a hard time remembering what it's called. Basically you paint the wall with this like putty, and then you like use metal to make it shine. Don't remember. Venetian plaster.
Okay.
I think it's called. Anyway, just a giant time suck. And when I sold it, the new owner ripped it out immediately. So yeah, I overimproved it. That's the first mistake. The second mistake would honestly be that I managed it myself. So it was gross profit was about $3,000. And my net profit, if I manage it myself, was around $600. My net profit, if I let somebody else manage it, would be more close to $300. And I thought to myself, if I do it myself, I'm going to save half. I'm going to make twice as much, quote unquote. I'll make twice as much if I do this myself. So what ended up happening is in 2008 and 9, there was like there was a lot happening with the economy as well, and finding good renters was a challenge. And I went a step further and just stopped doing what is the stopped
Like
taking
evicting?
applications.
Oh, applications.
And just like trusting people. And by the way, a property management company never would have done this. So I lost thousands and thousands and thousands of dollars later on with attorney fees, and then making the contract that I should have made long time ago. Eviction, like you said, and one of the evictions took like 6 months or so. And during that 6 months, they were upset and they let their animals use the restroom all over. And it cost a lot more for me to save $300 a month. So managing it myself was definitely something that I had a challenge. Now, I had experienced management for a year before, but it's interesting with me when I have a responsibility to read Quinn and his bottom line, and he tells me he wants it done a certain way. It's like, that's the end of the road. I can only do it the way Reed wants me to do it. I wasn't going to cut corners for his property. But once it was my property and people wanted to move in and they didn't have enough money, their credit was a little low, whatever the case would be, I'm like, okay, I trust you. It's fine. And I didn't do the things that I had learned. So that was another reason that there was some issues with the property. And if I were to say, I think those two are good enough to start with.
That's great. That's really good. And did you partner with anybody on this property?
Yes, and yes, I did. I ended up having, my credit score was high at the time. I made decent-ish enough income, but I was super good with my bills. And I had started this handyman company that started serving the 18 unit and the 4 unit and the other condo. And then some of my neighbors who had gone to like church with me and stuff like that. So I started this handyman company and it started growing, and I stopped doing bartending. And even though the handyman company was doing really well, I had 13 employees. I would charge like 45 or 65 an hour, pay my guys like 10 an hour. So there's a good like spread with 13 people working 50 hours a week. And so I thought that I had it made. And just a little bit before I applied for the loan here in 2008, you just had stated loans left and right. When I was trying to buy this property, you could no longer do like stated loans. They had to get 2 years of bank statements. And because I only had 1 year with this business at the time, I couldn't qualify for a traditional loan. I went to bank to bank to bank to bank to bank, and finally reached out to one of my handyman clients where I was remodeling his basement and doing some other things for a house he was flipping. And I asked him, I said, Tom, like, would you ever like pay for this? Because I knew he owned a house in New York City and another one in like in Manhattan and another one in San Francisco. And he flipped both. And he was like, oh yeah, I made like a couple million on that one. I made a little over $1 million on this one. And I'm like, that's so much money. What do you do with it all? And he's like, I'm trying to find ways to invest. I go, well, would you ever want to be the bank for me if I went and bought a little multifamily? And he goes, yeah, I'd be open to that. You do good work. I like you're honest, you're integrous. I enjoy working with you. So he ended up purchasing the property. It was like $370,000 or so. And then he made a mortgage out to me. So like 100% financing, nothing down.
Yeah.
Robert, what's that guy's name?
Right.
Nothing down. I don't know his name. But the point is, yeah, that was kind of my partner. I needed to work with somebody. And that was the whole reason why I started a podcast called Creative Real Estate, because that was like my first creative real estate deal. And I just kept doing one every now and again, not like multiple times a year, but a few times over a decade. I would be like, oh, let's do another one. And I'd find somebody to finance it or find an owner to carry it or whatever. So that was kind of my partner. And in a way, I kind of ran it on my own as well.
That is really cool. That is a cool story. So then, I was going to ask you next about this. So Creative Real Estate Podcast. So there's something like, I think you have over 600 episodes now, something getting close to that anyways.
It's definitely over 5 for sure.
Yeah. And so when did you start that? And what was the impetus for that podcast?
Started recording in June or May or June of 2017. Launch day was September 11th of 2017.
Okay.
I started it at around the same time, like a few months after I had started a Meetup group. And the reason for both is because I had, I was told your network is your net worth. And I believed it. I believe like if you attend Meetup or if you listen to a podcast, that's one thing. But if you're the host or the owner or the operator or the cream of the crop of that Meetup or of that podcast, I feel you're more likely to find more deals, and B, find more money. So as a syndicator, and that my goal was to raise more private equity, I thought it necessary to start a podcast. So that ended up launching in 2017. And we did episodes at random. We were trying to do weekly, but it would be like twice in a week, and then we'd wait 3 weeks, and then it would be once in a week, and then we wait 2 weeks. But after some time, I decided to put more time and attention into the podcast. So what I ended up doing is setting aside a whole day, and it's been Wednesdays for years and years and years, setting aside a whole day just to record content. So I'd record with other people and interview, kind of like you're interviewing me right now. And so I'd do Q&A. And then every now and again, I would do an episode where I would spend like 5 minutes just pouring in on one subject. And I was still publishing one a week. Mm-hmm. And I had over 150 insane, just like pre-recorded episodes. Mm-hmm. And so I've decided I need to start pushing these out. So I've always recorded around 7 a week or so. And then I decided I can start doing like once a day, or even I did twice a day for a little while. And it's been really supportive. Like having a podcast has helped me network with the guests a lot better. Co-GP on deals, raising more money from other passive investors that I invite to the show. And I've gotten a lot of passive investors just by telling them that I had this podcast. Oh, you need to listen to episode blah, 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 because that answers your question. And then they'll go and listen to it. And later on, they'll say, man, I want to invest with you. I've listened to tons of your episodes, and now I'm ready to put my money with your company. So there's been so many benefits from running that podcast called Creative Real Estate Podcast. So
that is fantastic. And so then I guess that takes me full circle to the podcasting on podcasting, and that just launched, right? And tell us a little bit about that. And I know you also have Grow Your Show, which is a method to get people to get other people developed on how to do a podcast, right?
Yeah. I'll try to be brief so we have enough time for the presentation. But just in short, the podcast on podcasting came about because I want to serve more podcasters. Just like the real estate podcast helped me raise more money and find more deals and get more credibility and speak at more conferences, which helped me get more credibility and get more private equity and make more connections with more people at a high level. When I decided to go all in on growing a podcast company, I knew that I needed to have a thought leadership platform to be able to make that awareness, add value to my perfect client, etc. So I own a company called Grow Your Show, and you find it at growyourshow.com. We support podcasters. And then the podcast on podcasting is hosted by me and my company, growyourshow.com. We just launched, as you said, about 2 months ago. Episode 50 comes out either, I think, on Monday. And we, just like on that other podcast, and I don't want to scare anyone who wants to start a podcast and make you think you got to do it this way, but I probably have currently about 60 more episodes already pre-recorded for the podcast on podcasting, because I spend a lot of time like getting that content and telling people that it's going to come and getting them excited about the future. I spend a lot of time with the prep of it or the pre-launch of a podcast more than most people. And so I have plenty of content. I could take a year off for sure and publish at least once a week. So
that's awesome. That is so fantastic. Well, cool. That gets me excited about the potential of podcasting. So I appreciate that. So if you wouldn't mind, you can start your presentation. You're going to tell us a little bit about 3 reasons why now is a good time for multifamily. So I'll let you take over, and we might have some questions come up, and I'll stop you along the way.
Cool. Let me go to present mode and share my screen. Oh, you got to enable me.
Oh, yes, you're right. Screen share, multiple participants. All right, you should be able to do it now.
Cool. All right. What do you guys see? See my screen?
Yep.
Perfect. Yep. All right. I know that there's always a little bit of controversy of like, should we buy a apartment right now? Should we be buying this other thing right now? Should we buy nothing right now? Should we just wait? Are we at the end of a market? Are at a cycle? Is it about to go down? Are we going to lose money? Are we going to lose our passive investor money, etc.? These are all thoughts and concerns that we all have. Now, I'm speaking to you if you plan to be a passive investor. These things will help you. And absolutely, if you're an operator, you should use some of these unique things, because you haven't heard all of the things, or maybe you haven't heard them the same way that I'll present them today, but use these to your advantage or to your passive investor's advantage, because they allow for a more compelling story or reason for passive investors to be involved in apartments right now compared to many other asset classes. So that's the whole goal, is to open your mind to it. This is a short-ish presentation. So we'll try to go into a lot of detail. I'm going to give you a couple of links as well that I'm going to put them into the chat box. And also, Andy, if you want to email them to people, feel free to. But let's get into these 3 reasons. And I like to go backwards, where the last reason is the best. I like to do what Jay Leno or the late night show used to do. So number 1, it's like the trends that are out there are showing multifamily to be very, very strong. For example, the number 1 is millennials are a couple of things about millennials. Number one, there's the largest, and feel free to write this down. There's the largest amount of 18 to 35-year-olds today living with their parents. In the US, there's more 18 to 35-year-olds than ever before living with their parents. That does mean that they'll probably be moving soon. They'll probably be trying to move soon, or else they're going to be the 40-year-old virgin that they watched that movie and they were like, I'm never going to be that guy. So they're going to be moving out at some point. And additionally, with millennials, there is something interesting about them where they seem to want to travel the world. So they cut costs very frequently on their house and even their car so that they can travel the world and say that I've been to Spain and Portugal and all of the other places. So another thing about them is they don't really want to mow their lawn and do all of that extra additional work. If I can try to blanket statement a millennial, no offense if you are one, many millennials happen to be a little, what's the word for it, when you feel like everything's just owed to you. Your parents never really made you mow the lawn. This is like the first generation that didn't learn those things as much as like boomers, etc. So what is that word? Why can't I think of the word, guys?
I know which word you're talking about.
That's okay. We'll pass it. Pass it. Yes, entitled. Yes. Entitlementia. So there's a lot there where they may not be used to doing all of these different chores that some of the rest of us always had to do. And this is the first age that has some of those things. So it's really interesting. They want to travel. They don't want to spend a whole bunch of money on their house. They don't want to spend a whole bunch of money on their car. They'd rather experience things. They don't want to have to do all of the lawn. They want to be able to do what they want, when they want, how they want, where they want. Baby boomers are the richest, by far the most wealthy ever age class. I don't know if age class is a real term, but the baby boomers are the richest of them all, richer than Gen X, Y, Z, and everything in between. So the boomers, there is two things that are happening with most boomers. There are two things that are extremely prevalent with baby boomers. A, they either own multiple houses in multiple states or even countries, but they either own a house in Florida and New York and Denver and LA and Wyoming, or they're the complete opposite. So one couple either owns 3 or more properties, or they want to live in an apartment, just like the millennials. They've worked their asses off. They've been doing this for a long, long time. And now what's the next step for them is sit back, relax, don't mow my own lawn. I'm just going to travel. I deserved it. I've put a lot into this life, and now I can do whatever I want, and I can travel. COVID changes. There's a few COVID changes, but really what I should have put on here was just cost of materials. But a lot of that happened because of COVID. A lot of that happened since COVID. A lot of that happened as a result of many different companies not working and not producing different things. And so at any rate, you all probably know that wood, like building materials, skyrocketed recently. So for example, I told you that I owned a handyman company. We've finished lots of basements. We've remodeled lots of kitchens. So I've bought a lot of building materials. And I remember when 2x4 by 8, a little 2x4 was about $6. And when I was just at, I think it was on Sunday. No, it was on Monday night. It was on Monday night I went to Home Depot. And while at Home Depot this week, I wanted to check out how much are these 2x4s. And at the Home Depot that I was at, they were $65.99. So they were 11x what I was used to paying for them before. Additionally, you might know OSB. A lot of people say that the OSB is like the cheap wood. Don't use it. You want real plywood. OSB, saw a picture online of somebody using, I think it was 5/8 OSB, like the cheap kind of plywood. And it was $105, $105 for one sheet of OSB. So all these building materials skyrocketed. And as a result, many home prices went up as well. Just for an example, houses in my neighborhood, the ones that used to be 500 to 600,000, just this year are now 850,000. They've gone up almost 60% in many cases in my neighborhood. And I live in like the most rural part of Colorado ever. It's called Conifer, Colorado, by Evergreen, Morrison, and Bailey. All our yards are giant. You don't have neighbors right next to each other. People don't really want to live this far up, but even these homes have gone up by 50 to 60%. And as that happens, and we go back and think about the millennials that we were talking about before, that the 18 to 35-year-olds, we have the most amount of them living with their parents today. Just think about the cost of living, the cost of the houses that they need to buy. It's going to be a huge challenge if they want to move out of their parents' house and into a home. So it just adds to the fact that apartments are likely to continue to grow with supply and demand to increase the price of rent and absolutely increase the price of the property. And I believe likely to continue to see cap rates compress. And for anyone who hasn't heard cap rates compressing, what that means, all it means is that people are willing to spend more on an amount of income that a income producing property can bring in. They might be more willing to, I'll just take a 4% return then, instead of the 10% that we used to expect. So there's a few things with some trends. Now I want to talk about William F. Sharp. Who's all with me? Put in the comments if you're with me. All right. This part is really interesting, and most especially if you've never heard of William Sharp before. So you can see this is a black and white photo, and you see all the math behind him. He is brilliant guy. And his goal was to try to figure out what the return was actually worth based on something called risk. Because he looked at different portfolios, and some of them did well over a short period of time or a long period of time, but it was extremely volatile. So they may have lost money if they got out at the wrong time. And he looked at other portfolios that made just a little bit of money, but they didn't have any swings. So it was like a good deal for him. And he wanted to find out, how do you see what is called a risk adjusted return? What is the return that I'm going to get if I adjust for the risk that I'm going to have to go through, the ups and the downs? So he's a really brilliant guy. Feel free to look him up, but we call this the Sharp ratio. And many people don't know what it is. If you're a portfolio manager, you likely use this every single investment. If you are somebody who just puts their money into the stock market, you may not have ever heard this. And if you're a real estate investor, you probably never heard this either. So I want to share with you what the Sharpe ratio is. And I'm going to give you two videos. So let me escape so I can just get to these two links for you. And actually, I'm going to do them one at a time. Copy, put this in the chat box for you. So it's about a 90-second video that you can watch. And then this bottom one that I'm going to give you is about a 5 to 6 minute video. Okay. I want you to watch those, especially if you don't clearly know what the Sharpe ratio is, because I'm going to explain it to you. You're going to probably get it, but you're going to forget it. You're going to not be able to eloquently say what the Sharpe ratio is anymore in a day or two. So I want you to watch both of those videos when you get a chance. So basically what this is, you first take the return that you did get, okay? You've got the return that you ended up achieving. And then you minus out the return that you could have got with no risk at all. So that's basically like a 10-year treasury bond, which right now is 1.51%. The treasury bond yield today, or yesterday anyway, when I looked this up again, was 1.51 for a 10-year treasury bond. That is the base. That is, you can get that return without even having any risk. It's a sure deal. It's basically guaranteed. I never try to say the word guarantee almost ever, but in this case with the treasury bond, these are basically guaranteed returns, and it's 1.51. So let's just pretend as though you got a 10% overall return. That's what you ended up achieving. And the return that you could have got if you had zero risk at all was 1.5. And now what you have up here in the numerator is 8.5%. 8.5%. That's the difference. That's the extra amount of return that you got was 8.5% over top of what you could have got if you had no risk at all. And then what you do is you divide it by the standard deviation. And so what this means, it's kind of like you divide it by the percentage, basically, that it can go up or down. The standard deviation, it can go up to here, or it can swing down to here. Some weeks will be way up, other weeks will be way down, or some years will be way up, other years you'll be in a bear market. Okay, so you take the number that you really got minus the number you could have got, and you divide it by the standard deviation. Let's call it 20. So in this case, you'll have 8.5 divided by 20. And what that'll end up being is somewhere around 4.5. I don't have it. Someone go ahead and do the math for me. 8.5, I guess, minus divided by 20. Whatever that is, put that in the comments for me, and we'll move to the next area. It should be around 0.4 or 0.45 or something like that. Nobody's done it. Devin gets a pass because he's driving. All right, here we go. So basically it's 4.5%, or in other words, it's 0.4. It's really 0.4. This is like the 0.425. That's what you would get if those were the numbers. And I want to talk to you a little bit about the S&P 500. This is a very important piece that you should remember as you think about this risk-adjusted return. The S&P 500, they pull 500 different companies together. The reason they pull the 500 companies together is because of William Sharpe. William Sharp knows that if you you spread your risk, then you're less likely to have big upswings and big downswings, because with 500 companies that they're investing in, it should be as stable as possible. Remember that. It should be as stable as humanly possible. So that's the goal with S&P 500, is to stabilize the ups and the downs. And so you'll put your money into the S&P 500. They'll spread that risk among 500 different companies so that you can get a certain amount of return. With the S&P 500, it ends up being 0.27, which basically means the numerator is a quarter of the size of the denominator. Remember that as well. The numerator, the return that they really got minus the return that they could have got without any risk at all, is 25 or 27% the size of how much the volatility is, the ups, the downs, etc. And they score a 0.27. I'm here to share that the absolute minimum you should probably be looking at ever is a 0.5, because that's when I see the probability of you actually making money if you're invested in it in a long enough time, over a large enough time frame. So the smallest you should ever look at is 0.5, because that means that you're getting 10% return over time over a 20% volatility, a 20% ups and downs. So the S&P 500, 0.27. Private equity, slightly higher. Retail, now, unfortunately, this is from, now hear me out, this is from 2018. Retail probably went down in 2020. So don't think that these are all like still exact, because retail looks like it's more than twice as good as S&P 500. But we're not sure unless we look at the most recent there. And assisted living, office space, office also probably went down a little. Self-storage most likely went up. I think that over the last couple of years, self-storage has probably been performing a little bit more. And multifamily, in these 20 years, from 99 to 2018, multifamily, over a 20-year period, outperformed the S&P 500 by about 5.5 times. Remember that. Let it sink in. S&P multifamily outperformed S&P by about 5.5 times, based on how much you're getting over time, minus what you could have got anyway with no risk, divided by the volatility, the standard deviation. So there's a bit of information. I had another one of these that had a 30-year projection that it ended in 2007. And these things were all a lot smaller there. So these are kind of coming up in this time period. When using the Sharpe ratio, it's best to try to see these adjustments over the longest period of time you can. So if you can do 5-year, great. 10-year, way better. 20-year, like you're really crushing it. 30 or 40 years, like really, really good. You'll also want to know kind of what recently happened and how this is trending up or down. But just wanted to drive this point home, how strong multifamily is compared to like the S&P 500, even though they're investing in 500 different companies. All right. Number one, inflation. Over the last few years, as we were talking about, I have a podcast that I ended up selling that podcast, but I had run that podcast. It has well over 500 interviews, and I'm the interviewer. on almost all of them. So I've interviewed lots of smart people, lots of really cool brainiacs that have multi-billion-dollar portfolios, etc. And one of the things that the smartest of the smart people that I respect and admire share with me on the podcast is the power of long-term fixed debt, the power of borrowing 80% or so from a bank at 2 or 3 or 4 or 5 or 6%. Right now, today, you can get apartment loans, multifamily loans, and even single family loans in the area of 2-ish%, 3-ish%, 4-ish, 5-ish, and 6-ish%. And it just depends, like, is it a 7-year term, a 10-year term? Is it a 15-year mortgage note? Where is it a, what's the word? I don't know why I can't think of it. Is it a, what are those temporary loans for construction and things like that? Not a fix and flip loan, but a.
Are you talking bridge loan or home equity loan?
Bridge. Yes, thank you. So is it bridge debt? It might be a little higher. Is it a HUD loan with a 40-year term on a HUD loan at 1.5, 2.5%? It all depends on what you're doing, but you can easily get this stuff between 2 and 6% all day. I had a friend yesterday look up inflation, and he told me that last month alone, not over the course of an entire year, but last month alone, we had a 4% inflation. So when you can get long-term fixed financing on property, the goal would be to get it on the biggest properties possible. Sure, if you can do it on a single family, that's wonderful. But if I can go and get a $20 million loan on 100 or 200 unit apartment community, even better, even stronger. And it's going to allow you to hedge against that inflation. And especially if we have inflation, like the 4% last month, if we are having inflation, the smartest thing we can do is purchase the biggest amount of property, because it's just going to go up. It's a huge hedge against that inflation, allowing us to actually make money, increase our income, etc. So as you all know, the value of a dollar today versus the value of a dollar either 10 years ago or 10 years in the future, it's always a big, big difference. So regardless, if you're holding money just in a bank account, you're wasting it because it's going against inflation. But if you've got it in a property, it at least hedges that inflation and increases. And then when you couple it in with some of the things that I shared before, like these trends with millennials, boomers, and cost of materials, house prices going up, the Sharpe ratio already showing that multifamily is the best asset class I've ever seen by far, and utilizing this long-term fixed financing where you only have to put a little bit down and let the bank take the rest of the risk if it goes down, and you get the reward if it goes up. Kind of remarkable. And then there's just one bonus, and it comes from when I was in university. I was a Wolverine. I mentioned to you that I managed property in Provo and Orem. And I was going to this college, Utah Valley University. It's actually a larger university than Brigham Young. Randomly enough, I think we had like 60,000 students, and Brigham Young had just a little less than that, but they are within 10 minutes from each other. And in the center of this building right here, in the center of this building, you can't really see it, but it's just, if you go straight up there, I had an entrepreneurship class. And the teacher of the entrepreneurship class taught me a lot of really cool things. And one of the main things that he mentioned was something called supply and demand. And I didn't believe him. I was just like, everything else that you share, you're so smart and it makes so much sense. But if I had, for example, if I wanted to buy a car And back then when I was in university, I had bought like a $12,000 Honda Accord. It was 3 years old. And I was like, if I wanted to buy a car, I would pay the same amount for a car, whether there was one Honda Accord in front of me or a million Honda Accords in front of me. I was like, it's always going to be worth $12,000. Why would I pay any more or any less? Because of the supply. And so he beat this into my head. Most of you are smarter than I was when I was in 2005, 6, 7, 8. Most of you are well above that. But I was like, I don't get it. And I started trying to study it because I believed in this guy. And I was like, what is happening here? Supply, demand. And I found out that it really does affect pricing. When you have an influx of things, then they will lower the price just so they can make a sale. When they only have one, they have all the power. They don't need to sell it. They'll get the highest and best price. So as we think about this fourth and final thing, I say the 3 reasons why multifamily, you got to buy it now. But this supply and demand, this fourth additional bonus is so true, and it couldn't be more true than it is today. With the cost of building materials, it's more of a challenge to go out and build apartments today. Last year and the year before, when building materials weren't as high as they are today, there was already a challenge building new apartments. They had to build apartments that were A+ class just to make it worth it. They had to build the nicest luxury places just to be able to break even. Now, this isn't the case everywhere. There's some people trying to do affordable housing, but it's a challenge. It's difficult to be able to do that. And it's even more difficult today in 2021 to be able to, especially with the cost of building materials, and in some cases, how long it takes to get permits for us to be able to catch up with the demand that we already have. Go ahead and look in Denver. Go ahead and look in Dallas and other cities throughout Texas. Look in Oklahoma. Look in Georgia. Look in Alabama. It's a challenge for people to even find apartments to buy. Cap rates are compressing, and it's becoming there's not enough of them. So that shows us the longevity, the potential of our money being safe and protected in an asset class like apartment investing. So those are the 4 things. I'll say them just real quick and make sure you write them down. The trends, the Sharpe ratio, inflation, and supply and demand.
That's great. It's really cool to see just each of those and how they play on each other, and how it creates the picture of the demand is truly there, both from the tenant perspective as well as the investor perspective. So now I know there's always naysayers, right? So what if someone said, hey, it's a seller's market right now. There's demand is high. What would you tell that person?
Well, they're right. It's a seller's market right now. And they're right that demand is extremely high. But one of the places that you can go to get a little bit more information is CoStar. And the CoStar reports that were coming out in 2019 for 2020 and 21 were already showing that most, at least the good markets that you and I probably have been looking at, most of those markets already had a very strong 10-year picture. Mm-hmm. Over the last couple of years, that has increased even more. So if you can take a moment to just pull a CoStar report, there's a few things that you might want to look at. Absorption rate. If you haven't heard it, just write it down. And so what you'll do is you'll look at a market, and you do this city by city. So Tulsa has a different absorption rate than Oklahoma City, even though they're only like an hour, hour and a half apart. So same thing with Dallas versus other cities, other like parts of DFW. They will all have a slightly unique trend, even though they're part of the same MSA. But then you look at Houston, and you look at San Antonio, and you look at Austin, which Trevor has a picture of Austin in his background. You look at these different cities, and you will notice that they have an extremely positive absorption rate. All that means is they're trying to build. They're doing their best to build, but they cannot build fast enough to cover the need. And so CoStar reports right now are showing really, really well in most cities, most decent places where you'd want to invest over the next 5 and 10 years. So that's that best way. If you're like actually feeling concerned and you're like, I don't believe everything that you said, just go check out like the most, what's the word? I forget words all the time. I'm dyslexic. It happens. The most credible source of aggregated data around. So CoStar report, they spend insane amounts of money making sure that they know where things are going. They own apartments.com. So they like know basically the rents everywhere. They know how fast people are moving in. They know how fast people are building, and they know the costs of living. And just if I could add to it, real brief, one of the big factors that allows us to know that apartments are a safe investment when I say safe investment, I'm acting as if you're not my passive investor, because my attorney says I can never say safe or secure or whatever. So I'm just acting as if you're not my passive investor. They are a safe investment compared to a lot of other things. I lost my train of thought. Based on absorption rate and based on, it'll probably come back to me. But it definitely was going to help that topic, the question that you just had, Andy.
That's fantastic. You've painted an excellent picture. Okay. I'm opening it up to questions. What questions do you have, guys? Lots of good information here, and I want to hear your questions for Adam, whether it's on this topic or other things. We've got them here. So
I got one. Adam, when you started your podcast, what were the two biggest challenges you faced with doing that?
Probably the biggest challenge with launching the podcast was the consistency. As a business owner, and at the time I had, and I still have a property in many states, but at the time I had a bunch of properties in Florida. I had a bunch of properties in Ohio. I had some properties in Minnesota, in Missouri and Texas and Tennessee as well. And we were purchasing a property in Connecticut, and we own it now. But at the time we were like doing due diligence on it, and we were looking at other markets as well. So my biggest challenge was like, how do I stay consistent? I know that I want my podcast to, drop episodes on a regular basis, but being involved heavily in my business and the decision-making of the business, and putting out fires from owning property all over, it was constantly this feeling of being behind the 8 ball, and I didn't like it. I didn't like the feeling at all. It was stressful. It made me feel bad. It was embarrassing because I had told people I'm going to do weekly, but I couldn't even do that. So that was probably the biggest challenge. And the way to overcome it, so that I can hopefully add more value to you, the way to overcome it is to record. So I've overcompensated. That's like, that failure and that feeling is why I told you before that I had gotten up to 150 pre-recorded episodes on that podcast. And before I launched this one, I had over 60, and I probably have around 60 left right now today. Like, I have a lot in the bank, and it's most likely due to me feeling like I was going to quit my podcast altogether because I couldn't even publish an episode once a week. That was the biggest challenge. Second biggest challenge was growing my audience, increasing my listener base. I had a meetup group that ended up, it was the biggest meetup. It was the most highly attended, the most regular meetup in the entire state of Colorado when I launched my podcast. And I thought to myself, I'm going to crush this. It's going to be easy. I had a weekly meetup group. We had up to 176 people at each and every single Thursday meetup. And I thought it was just going to be easy. So finding a way to get in front of my listener was a huge challenge. What ended up happening is people heard about my meetup. People were flying into Denver just to go to my meetup, like Rod Cleef and Joe Fairless and Dan Hanford and Whitney Sewell. And I just, so many amazing people came to Denver, and they were at my meetup. And I thought, this is amazing. But nobody knew that I had a podcast. So I didn't know how to market it. And I was thinking to myself, if you build it, they will come. I watched this show when I was a kid called Field of Dreams. And I was thinking, boom, all I have to do is have a podcast and I'm the most famous guy in the world. And it really hurt me that that wasn't the case. I actually had to work to promote the podcast, to get it in front of people. And I didn't know how to do it. So to add value to you on how to solve that, A, hire us because we know how to do it. But B, a couple of things that you can do in order to get in front of people is when you're launching, I want you to have, and hopefully you can write this down, have a pre-launch plan. This means like a marketing strategy that is happening before you even have a podcast episode aired. You're already doing a pre-launch plan. Second, have a strong launch plan, and that's defined as 8 weeks of a launch. So have a strong launch plan. And what I'm saying is, and I have to say and qualify this. A guy named Steven Pesavento was in my mastermind. I have a little inner circle. He was a member of it in 2019. And anyone who's in that mastermind group, I pour into them with anything I can. If they want to have a meetup group, if they want to have a podcast, I pour into them. Now, with that said, Steven did a whole bunch of stuff on his own as well. So I cannot take credit for all of this, or maybe not even half, but let me just pour into you real quick. Steven's podcast, he ended up doing a few things during his 8-week launch. And what ended up happening, his podcast is called The Investor Mindset. It's super popular today. I mean, like, he's got so many followers and so many listeners. It's incredible. I'm so proud of what he's been able to achieve. But as we were working on his podcast, I was promoting it with some email blasts. I also did some social media blasts, and I also shared with him a few things that I saw work for other people, and then he had his things as well. For Stephen, he ended up being top 10, and I have screenshots of this because I was so happy for him. He ended up being top 10 in 4 categories. One of those categories includes new and noteworthy, which is like the most impossible place to be on. The second one that he was on was the business category. And then he was also in the investor, real estate category and the personal growth category, top 10 in 4 different categories. Here's some of the things he did during that 8 week. And some of those things I did as well for his show. A, email blasts. B, phone calls. Like, he's actually calling his friend, and he's using this this script that I can share it with you. I came up with it like long before I met him. The script goes, it has 3 major points. Write the word trust down. That's the point number 1. The second point is episode or 2, an episode or 2. And the third point of this script is honest review. Okay. So what we have you do when you're calling your friends and letting them know about your podcast is you say, "Hey, Pat, it's Adam Adams. I'm launching a new podcast. I don't know if you knew it. The reason why I'm reaching out is because," oh, and use that word "because" as well. That can be a bonus. The reason I'm reaching out to you is because, Pat, I need a couple people that I trust to just listen to an episode or 2 of the podcast and simply give me an honest written review. So the psychological reasons why these are essential for anyone who wants to know is when you say a couple people that I trust, it's very personal and it pulls on their heartstrings. They're more likely to actually do the thing because you need a couple people that you trust. I want to be someone that you trust, Pat, so I'm going to do it. Number 2, listen to an episode or 2. There's lots of reasons why that part is critical. A, if they give you a rating and a review without listening to your podcast, it works against you in the podcast algorithms. So it actually makes it look like you're paying for fake stuff. And podcast Apple does not like that. They will shut you down. They don't want anyone to see it if that happens. So you at least want somebody to listen to an episode or 2 before they give you a review. Another reason why you say listen to an episode or 2 is because you just get more downloads and listens by asking that than if you just ask for a fake review or something. The third part is to leave an honest review. You should underline the word honest, and you should put to the side of it the word 5 or the phrase 5-star. Put that up somewhere else, and then cross out 5-star in red. If you ask for a 5-star rating, people feel like you're pushing them too much. It doesn't feel like their idea. If it was a good rating, they would feel like that it's inauthentic, and they don't want to do that. Nobody wants to be compelled to do a 5-star rating. They just want an honest rating. So if you ask for honest, they're more likely to actually give you a rating and a written review. So if you just do that, that will be a huge piece. And then usually with like clients, and I'm trying to help you do all this, we'll sit down and we'll figure out who's on your email list. How should we talk to them? What types of email lists do you have? Let's segregate those email lists. So it's not just real estate investors. It's these types of passive investors from this city, these types of active investors from this city, these types of attorneys, these types of whatever is in your email list. We try to figure out who are they, how should they be spoken to, and then we create a blast of emails. And here's the takeaway that you should get from this. When sending these emails, you're going to send a little bit more than you're comfortable with. You're going to say to yourself, oh yeah, I'll send out an email. It's going to be an extra email. I always send once a month. So I'll do an extra one this month, and I'm feeling anxious and scared because I think my email subscriber might actually run away from me because I did 2 in a month. Okay, so get that out of your head. During this, we're going to do 3 to 5 emails, and it's all going to be in 1 week, and it's all going to be consecutive around the topic of your podcast. Bonus, if you can, if on this podcast you find a way to incentivize or have a giveaway that your avatar wants in order to do listen to an episode or 2 and give you an honest review. So it's a bonus if you have that. I was just talking to a client earlier today. His name's Tate Seamer. Tate and I were talking about all sorts of different strategies, how he could do this. And the big takeaways that came from that conversation that I could share with you is he's like, hey, I'm going to get a nice silver coffee mug. And it's going to be, my logo is going to be just giant on there. I'm going to send it to them. And I was like, Tate, and I'm sure he won't mind if I say this. I'm like, Tate, your perfect listener doesn't care about your logo. When someone sends me stuff with their logo on it, I usually throw it away. What if you're going to send a coffee mug, why don't we put something cool on there like happiness is passive cash flow, registered trademark. You can't take this one. It's gone. Why don't we put something on there like, good morning, let's buy apartments together. Yeah, sure. I got my logo on there, but it's tiny compared to the big stuff that my avatar cares about. So as you're thinking about whatever your giveaway is, whatever you're going to incentivize people with to give you a review and rating, why don't we take a nice, sexy knife and engrave it, not with your logo, but with their name? I put on there Albert Wolf. I put on there Ty Valkins. I put on there Henry Fuentes. You care about you. You don't care about my logo. You're always going to remember who sent it to you. You're always going to look at that awesome knife and be like, Adam Adams was so cool to send me a knife that says Lily Richards. Well, maybe Lily doesn't care about knives. I don't know. But the point is, send him a nice bottle of wine. Send him a gift bag. Send him a engraved knife. Send him a coffee mug that has stuff on there that they care about, not what you care about. So at any rate, if you can have an incentive and we can maybe put it into the email, for example, that says, you know, it's your last chance to get that free mug with that cool writing on it that you want, or it's the last chance to get your engraved knife, or it's the last chance to get the gift bag that's worth this amount of money. It's the last chance for you to get this book. Second takeaway out of 2 that I will give you from the conversation with Tate just earlier today is he was talking about, oh, you know what would be really, really cool is if we like, what do you think? He said, what do you think about if we did a drawing? What do you think if we did a drawing? I said, that's a great idea. He's like, yeah, man, I could like give away an iPad. And I stopped him again. And I said, Tate, let's think about this for a second. Let me at least give you my opinion. iPads are wonderful. You either have an iPad already because you like them, or you don't, and you don't need another iPad, or you don't give a crap about iPads and you don't have an iPad. So why don't we think about something that everybody would want? Maybe 30% of the population would be like, that's so rad that I got an iPad. And I did that rhyming on purpose, pretend like I did. And so let's do something else that everybody seems to care about. What do people care about? A night out on town or a vacation. Everyone wants that. Everyone wants to go out to dinner, let their kids be watched if they have kids, and just get out with their sweetheart or their buddies, or their girls. Everyone wants that. Or a trip to Hawaii or a trip to Mexico where you pay for the flight and hotel, and it costs almost the same as an iPad, but it makes memories, and everyone's behind on this. Everyone wants to do that. So there's just a few takeaways that we could spend lots more time, and I could pour into you for podcasting. That's a fun subject for me, but hopefully those takeaways were valuable to you for your question of what was difficult about it. And those were the two.
Awesome. Thank you. That was great. Albert, you had a question. I saw your hand raised.
He's a bit frozen. Darn it.
He's frozen. Other questions?
I got one.
Sure.
Hey, this is Sidhu here. So I just wanted to understand what are the softwares that you use for multifamily management?
We are subscribed to and even have an affiliate relationship with Syndication Pro. Syndication Pro is one that you don't get until you have like at least one deal already closed. Probably you're trying to close your second or third deal, and now you're definitely going to subscribe to something like that. All it does is it manages, there's an investor portal that they can log in and see their numbers anytime that they want. Additionally, when you're doing distributions, you might have like $555,281.31. And you basically just push a button and it automatically shows the splits. And so Lily knows exactly what she's getting, and it mails the check to her. You can do this like without having to do a bunch of work. It can be integrated with your bank, so that you push a button and all of a sudden Henry gets Henry's, Sean gets Sean's, Sharada gets Sharada's distribution, and it's accurate. I have to say, and I'm embarrassed to say this, before we had Syndication Pro, DJ, my business partner who owns all the apartments with me, hand wrote dozens and dozens of checks. And two of the times that he got carpal tunnel and probably had to go to the hospital, two of the times he miscalculated the distribution, had to recall a whole bunch of checks, and then had to rewrite them. And his hand got even worse. And then we mail it out. So Syndication Pro, huge. And by the way, if you ever do work with them and tell them my name, you just get a discount. So we'll get something. I don't know how much. It's like $100 or something, but you will save money. You'll get like a free month. So tell them about Adam Adams and you'll just get a little bit of discount. But it's Syndication Pro, and you probably want to wait until you've at least closed one property. It's best to do this as you're closing on your second or third property. Other than that, we are subscribed to, and it's pretty freaking expensive. I think it's like $3,000 a month. It's CoStar. So we are subscribed to CoStar. And one of the things that we've been doing, and we're actually closing down our inner circle, but one of the things we've been doing with our inner circle is everyone in there just uses our CoStar. We got permission to be able to pull unlimited amounts of CoStar. I don't think you need to spend $800 or $3,000 or $6,000 a year on CoStar. I think that you need to know someone like Andy probably has CoStar in his company and is allowed to pull reports.
Yeah, I have connections that have CoStar.
So regardless, if you get a broker and some lenders, they will pull like this report for you. They'll give it to you. You won't pay a dime. I wouldn't like way overuse it, like overextend your welcome. But it's just, if you're not like a big company, I wouldn't waste money on CoStar, because there's other ways to get the value of CoStar by working with like a real estate broker or something like that. We have a few others, like I would need to pull them up in front of me, because Manny from my team is the one who uses all of this, all of these different websites. But we have probably 5 different ones. I will tell you a third one. It's called Send Out Cards. And I say that because for some reason we put it on my personal credit card. I don't know why, but I see the bill come every single month. It's called Send Out Cards. And as part of onboarding a new client, like when I say client, I really mean passive investor. When we onboard that new passive investor, when they get on our list, we get their mailing address, we get their address. Well, that's the same thing. And we also get their birthday. And so my team, I have a virtual assistant that on a regular basis is sending out birthday cards. We have 742 people on our passive investor list. So like we're sending out tens of these like nearly every week. Like almost every week we'll send 15 of these or something. So that's the third one I'll mention, is Send Out Cards. They're out of Utah. And my dad actually is a landscaper, and he just landscaped the owner's yard like a little bit ago. And I was like, Dad, are you kidding me? We use them. We love them. We've been using them for a couple of years. So Send Out Cards is not one specific to the finding of deals or analyzing deals or anything like that, but it's super beneficial for you if you're raising private equity.
Okay. Thank you so much.
Yeah. Albert. Mr. Wolf, is your internet working?
Yes, good evening, everyone. I have a question about, I was on a conference call this morning in California, and there are how these different government agencies and that housing commissions are buying up motels and abandoned hotels and turning into homeless dwellings. What's your take on that?
I appreciate the question, Albert, but I'm not able to answer. My take is I seriously love self-storage. My dad owns self-storage, so I used to snowplow it. I seriously love self-storage, but I'm focused on apartments, multifamily, which doesn't include condo conversions, divider walls, student housing. It doesn't include converting hotels. I'm like, I want to just buy I want to buy a apartment community that I can easily see the T12 and go off of that. Because I'm like risk adverse, and you could probably make way more money than me by doing what you're saying. I don't know. I just prefer to like stay in my lane. So I can't like eloquently or appropriately support you in your question.
Okay. I was just, because it's going to be taking inventory, off of the market if they're doing that, because I mean, it's, they're actually taking private property, and publicizing it, taking it over, converting it to, homeless. I mean, I think it's a noble endeavor, yet at the same, I mean, we are already in a tight crunch market. I mean, driving up prices. So, I mean, that being said, I was just want to know if
there was somebody,
there's any other investors that, what their take is on it.
There is somebody that came on my podcast twice out of 500 plus episodes. Having a hard time remembering which one he was, but he came on the podcast twice. And Evan, maybe it was Evan Evans. Last name Evans, I think is his name, but he has been focusing on like government tax credits and finding the types of properties where you have subsidizing, where the government pays a lot of it. And he's done things, I guess, in the realm of what you're saying. Evan, I don't remember his name right now, but he's been on the podcast a couple times and he's doing something like that. But I don't know very many other people that are like supporting homeless or low income and using tax credits, because frankly, that business model would probably, most likely, in my guess, lose money if you weren't getting money from like the city or the state or the county.
Mm-hmm.
Yes, I mean that's the problem too. Like with Section 8 housing, that there's big demand for it, yet at the same, the hurdles with the inspections.
Shoot,
I think we just lost him.
Shoot.
Oh, well, great. Well, I think that's it. We've been going for about an hour and a half now, and I really appreciate your time, Adam. You gave a ton of information. Really appreciate that. I have one last question for you.
Great.
You've given to us. Now, what can our audience, how can we help you? How can our community help you with your journey?
Yeah. Well, what's funny? I learned this about men. Like this is actually true. Men are really givers, and it's difficult to receive. And I am not really the manliest man, but it is tough to ask for help. So you've put me in a pickle. I suppose that if there was something that you could do, it would be like if you knew somebody who like wanted to start a podcast or wanted to offload the hard stuff of their show, you could help them by letting them know about our company, and we would love to support them. And I would be massively grateful for the connection. I'd love to help your friend. So, man, you put me in a tough place because it's so hard to ask for help. But if there was something, that might be what I would ask.
Awesome. Great. Thank you. Great. Well, Adam, it was a pleasure to have you on the meetup tonight. Really appreciate everything you've given to us.